Hey, a very good afternoon to everyone. My name is Willie, and welcome to InvestFair. So when I heard about this, when InvestFair actually invited me to come and speak and moderate on stage, I was like, yes. Why? Because it's been a long time since I've actually spoken to some of the big giants out in the industry. So let's give a warm welcome to the speakers here today. I will briefly introduce all of them. To my direct right, first, we have the CEO of Azure Capital, Mr. Terence Wong. Let's give him a round of applause.
Thanks, everybody. Thanks, everybody.
And then to his right is Mr. Swan Teck Kin. He is the Executive Director of Global Economics and Market Research of UOB Group. Let's give him a warm welcome.
Thank you, everyone. Good afternoon. Good afternoon, everyone. Thank you.
And finally, I think we all know him. He has been on the media, radio, newspapers. He is none other than Mr. Song Seng Woon. He's the economist for CIMB Private Bank. Let's give him a warm welcome.
Good afternoon, everybody. Good to see everybody here finally after 3 years to rub shoulders and catch up with these old friends. And if you got any question later, they will answer them all. I'm just here to clap only.
Okay, since we have a really short time for these three speakers to speak, we'll just go straight into where we are going to start, which is investing in this borderless era. So the topic is really investing in these uncertain times. So a lot of my blog readers, right, a lot of them, they came to ask me, especially one of this lady, she's an auntie, and she came to ask me, hey, Willie, I've been hearing a lot about analysts talking about doomsday, the market is going to crash and all that. And at the same time, she was also pointing out about recession, right? Over the last 2 quarters, we have seen how the GDP, US GDP, has gone into negative growth. So technically, that is sort of a recession. And I'll just like to quickly start off here. Are we in a recession? Maybe I'll just like to point this out to Mr. Song first on this question.
Okay, I'll kick the ball. I suppose I kick off the ball, and then they can pick it up along the way. I suppose very simply, recession worries indeed very high at the moment. Inevitably, when you start to tighten interest rate and tighten aggressively, even though it's from a low point, at some point down the road, the cumulative impact of the higher cost of borrowing will have some toll on economic activities, whether on your desire to borrow more money or less, or to borrow money to invest, to hire, etc. Are we at that point yet? I don't think it's the case in Singapore just so. We are recovering from the worst of the pandemic. We are still seeing, with events like this, a lot more activities. People who now can set up booths, who now can set up lighting shows, are able to see a pickup in economic activities. So from that perspective, it doesn't look like a recession is imminent. But obviously, further down the road, we certainly have seen Singapore, say, borrowing rate. I can't remember what it started with. The 3 months IBOR was next to nothing, wasn't it? 0.5. Now it's closer to 2.8 or thereabout. Is it painful? No, not quite painful, because we had seen significantly much higher interest rate. For those ape with white hair one, you suddenly have seen rates easily double this in prior years. So very simply put is, we don't think we are in a recession yet, but recession risk certainly has increased as inflation expectations stay high, and central bank around the world, including Singapore, the US, are all looking to see how they can pin back consumption and economic activities up to some point to slow. Can they soft land? It would be nice if they can, but never can one. So it tends to overshoot, undershoot at some point. So recession risk has risen. Certainly, if we want to take a 12 months view, that certainly is a higher probability. But again, is what's next if we were to see economic activity slow down? How quickly does things pick up? Whether it stay down for a longer period? These are the things I wish later we ask Terence. Yeah? So I'll pass it to Swan and take at this moment.
Yeah. So Song, you mentioned something about interest rates, and interest rates and inflation are basically both sides of the same coin. And if I recall, in the 1980s, we have seen an overheated inflation. Paul Volcker back then raised interest rates all the way to double digits, about 15%. And I'd just like to ask Teck Kin here, is the 1980s and today, the era which we are living in, the same, where you have interest rates going up inflation also creeping up?
Okay, thanks, Willie, for this question. I think just now Song mentioned about recession risk. Then now really come back with this inflation worry, right? So are we seeing the same kind of inflationary pressure compared to in the 80s? Now, for those who have got white hair, right, who experienced 1980s, 1980s inflationary kind of environment, I think today is slightly different. Today is slightly different. For one, if you look at the 80s, part of it is because of the extreme low energy prices at that time, the crude oil prices, and then you had this crude oil, the oil embargo by the Middle East oil producers. So as a result, if you look at the quantum of increase at that time in terms of the crude oil price, compared to today, it was like much worse at that time. Today, if you look at today, of course, Russia-Ukraine conflict causing prices to go up. These are prices, if you compare in terms of the increase, the magnitude is actually not the same as that in the 80s. In the 80s, it was much worse because the base was so much lower, right? The base was so much lower. Exactly. Yeah. So what we have today is that we have an inflationary pressure because of the crude oil price, energy prices, food prices as well, and also supply chain disruptions. Right, so all these factors combined are causing prices to go higher. But fortunately, at this point, we are seeing some turning in the inflationary pressure. Not the exact big turn yet, but we're seeing some stabilization. For example, crude oil prices around about $100 per barrel or so. So some people are looking at the beginning $200, maybe $150, $200. Fortunately, we are not there. We most likely we won't get there. So the long story short is that the inflationary pressures looks like there is a chance that it might be stabilizing and then start to head downwards. So that is a good thing. Unlike in the past, we have a double digit of interest rates and inflationary inflation rates that we are not seeing today. And also, just one last point is that the US and Europe are facing different kind of inflationary pressure compared to Asia. So in Asia, if you compare the two all these places, our inflationary pressures in Asia are much milder compared to the US. All right, we are still facing these higher prices, but much milder. That means the central banks don't have to tighten as much as the US. And that gives us a bit of a breathing room in terms of recession risk that Song just talked about just now.
I think you mentioned about global oil prices. I think that's something which is interesting, and I would love to come back on that later on. But maybe let's just dial down a bit, going down bottom up, talking about stocks a bit. So for me, I'm a bottom-up investor, and I like to look at companies, stocks especially. And one of the main concerns is interest rates affecting stocks, affecting businesses. So as a fund manager, Terence, when you're looking at stocks, stock picking, how does rising interest rates and inflation affect stocks today?
Hey, thanks, Willie. Hey, good afternoon, everybody again. Can you hear me? I'm just afraid the people behind cannot hear. Can, huh?
Oh, cannot.
Cannot hear? Okay, I'm gonna like speak into the mic because I can hear you see you craning your neck. What about right now?
You talk like you're singing in a karaoke room like that. You know, you still remember how the karaoke room? Just karaoke away.
Okay, I'm going to try to speak as loud as I can to battle against the noise over the other side. I mean the sounds over the other side. Thanks Willie once again, and I'm very, very, very happy to be here. For the last 3 years, I've been speaking into a screen, right? That's kind of sad because I cannot really tell whether you guys are like enjoying the talk or understand what I'm talking about. But right now I can see you in the eyes. If I see you a little bit sleepy, I talk a little bit louder. But I can see now you're still fresh. I'm going to talk your question regarding inflation, right?
Yep. So how does inflation and interest rate affect stocks today?
Okay, I have been doing a regular radio program every month, and they always ask me about this. And my constant theme since November last year was that inflation is going to be here, and inflation is going to hit us hard. I know Tekin was my tutor in university, so I'm not going to contradict him. Yes, it is not going to be as bad as what we see in Europe and all, but because inflation, all the inflation forces are going to hit the likes of Europe in US, and that we will fall in sympathy, even though our companies here will not be as badly affected as those in the US and Europe, but because the markets, I believe, will see a rock. We saw that in the second quarter of this year, right? And then after June, the market just went up and people were all very, very excited again. But to me, it is very, very clear, this is a dead cat bounce. Why do I say it? In the past, if you look at the last few years, a lot of money has been pumped into the system. Unprecedented amounts, trillions of dollars. Remember, I remember in 2020 March, April, we thought it's Armageddon. Everything was going to go south, right? And in the US, they were talking about unemployment possibly hitting 20%. Mind-boggling. But not only did we not do that, then the government came in and started to push, and all the governments globally started to flush our system with cash, and more cash. Unemployment rate not only didn't it go up beyond 10%, it went down to all time. It got really, really tight globally. The supply chain was an issue, and property prices started to go up, and prices of just about everything went up. So this was counterintuitive back in 2020, but this is what we're experiencing right now. Inflation will hurt, like say, the likes of US and especially Europe. Because if you look at Europe, I think the gas prices, like what Tekin was saying, it's very, very different dynamics that we are seeing right now. But Europe will be affected by energy. And guess what? I think that if Russia, and it's pointing towards that direction, will start to like turn off the taps. Germany, I think at the peak, depended 33% in Russia. Now I think it's still 25%. It's still high. As we get closer to winter, they are going to face a very, very, very long winter if they were to turn off the taps. If Russia were to turn off the taps. So now Europe is scrambling to try to store as much LNG gas as possible. And this, hopefully, and they're trying to have arrangement to share the gas. But once they switch off, I tell you, all bets are off. It's going to be very, very tough. Like I say, it's going to be long winter over in Europe. In 2008, 2009, we actually banked a lot on China to push, global economy up. They point like $4 trillion. But now even China, the economy is crimped. It's like hobbling because of all the political changes. So we cannot also bank on China. And I feel that if you look within Southeast Asia, we are very, very dependent on our trade partners. So this will have an impact globally. And I think that even though our markets in Singapore, the valuation is not expensive, We're talking about 12 times, 12, 13 times PE, which is still below the average. We're talking about dividend yields of north of 4%. But if the big wave is going to come and hit the big economies, the big stock markets, we will definitely fall in sympathy.
Wow. So that's very insightful, Terence. I'll just like to bring on a topic on what you mentioned about China, right? And right now with the tech crisis going on, where China is looking at tightening the regulations of technology companies, and also at the same time we are looking at a China property debt crisis as well, which has happened over the last 12 to 18 months. Maybe I would just like to throw this question to our two economists here. Maybe you can just pick, choose to answer. What is the current situation of the China economy right now, and where do you see this going on over the next 12 to 18 months here?
Wow. See, the gold finger just pointed at me. Okay, anyway, just a quick one on China, then I'll pass to Song. All right, for China, yes, just now Terence mentioned something very interesting, which is we cannot bank on China to rescue us this time round compared to 2008, 2009, where they had this 4 trillion rescue package. Now, China, what happened here is this. They had learned the lesson of all this flooding the system. So this time round, they are very careful in terms of supporting, although you can see slowing down because of zero COVID, and Willie mentioned about property market and also regulation on the tech sector. So even with all these negative factors, now China is very careful in terms of pumping liquidity or helping the economy, but they are doing something. They are doing quite a bit of things actually in terms of supporting or helping, but not in a very massive way. Unlike in the US, where after the new government came in, they continue to pump liquidity, right, in terms of trillions into the system or fiscal spending in the system. So China is not doing that, but at the same time, they are doing something more of drip feeds to the system, and hopefully that would. I'm quite confident of China having all these measures to counter the negative effects from the zero COVID and also from the tech sector and also property. So you can see some help rescue coming in from here and there and from time to time, but not in a big massive flooding kind of a measure. So there are some help going on. So I don't see China in going down the hill, that sort of thing. There's still some support going on. And also important thing is that the Chinese population is large enough and the income is still rising. No matter you say that, oh, it's slowing. If it's slowing, but it's not shrinking, right? It's not in a recession kind of environment where the income is shrinking. So very important. So consumers still have money to spend. And if you look at foreign capital going to the country, in the first seven months of this year, it's up by about, I think, 17% in terms of foreign companies investing in China. So foreign companies are still confident of China's outlook. And the most recent, in terms of zero COVID measures, the most recent announcement, I think just 2 days ago, they announced that all the foreign students who have the valid permit or from school admission or whatever, all the foreign students are allowed to go back to China, right? So this is something that has not happened for the past 2 years. If you have student letter from university, whatever, you just cannot go in. So this time round is so much better. So there are measures that are coming in slowly, so we can still, in a way, bank on China, right? Because it's our large trade partner for many parts of Southeast Asia and many parts of the world. So there's still some hope yet, right? So there's hope to counterbalance or counterweight what is the downturn that Terence talked about in Europe, the long winter, and also in the US as well. All right, so I'll pass to Song.
Okay, just to take off where Swan left off, I suppose again, just to reiterate, short terms, definitely there is challenges. But if I were to take medium term, let's say 5-year view, I think the China anchored growth will be fairly supportive of us and the region. For China, I suppose again, not just they have learned the lesson from excessive pumping of the economy, especially on the property side. So now they're far more calibrated, whether it is selecting which interest rate to cut, which to maintain, which area sectors to lend to, etc., pushing out. And clearly, if you look at the investment plan, not just coming in, but domestically as well, long-term structural infrastructure spending is massive. I mean, here we look at, let's say, for those old enough, 1998 recession and crisis, we came out of that. We started on infrastructure, Jurong Island plans. That was where the biomedical cluster came from. We do take long-term plans. For those of you still remember, I remember when I first started working in Singapore, 1990, and we were told about the Punggol 21 plan. Punggol, where is Punggol? Punggol 21, and today, this is now Punggol 2022 now. Now Punggol is a freaking developed estate with a nice sea view, for instance. Same thing is happening with China, except it's on a freaking massive scale. Whether it is water tunnel, whether it is latest technology to upgrade township to be more green, I think China is doing much more on greening its economy and industries than everybody else in this planet. So this is creating the opportunity, and this is where perhaps also Terence has companies all involved in that area of greening, sustainability development as well. That's why I'm more excited in terms of the longer term. Yes, we are facing significant headwinds, but the opportunity that comes through later from all these new technologies and rolling out of infrastructure investment, I think will be very exciting. Once they start to mature, and they will mature. When you are a centrally planned economy, you don't have to deal with politics every other few years or so. It is far more stable in terms of implementation, execution. Yeah.
Thank you, Mr. Song. So I recall earlier, Terence, you mentioned talking about Singapore stocks where the dividend yield is still really good. The P ratio, is still relatively low. How about shifting gears to outside of Singapore, where we're looking at the tech sector, especially Chinese technology companies, US technology companies, and how they've fared over the last 2 years? Is interest rates, so they say, or at least I read, that interest rates affect the valuations of these technology companies. And thereby, a lot of these tech stocks have actually came down, quite aggressively, especially since the start of this year. Do you agree with this?
Okay, first up, this is the logic for why technology companies are very, very interest rate sensitive. If you look at, say, year 2000, during the crazy dot-com boom, when they started to say, I want to increase interest rates, they started, all the dot-com bust started to come. But why is that so? Because technology companies, many of them are banking on future earnings, right? So if you were to apply discounted cash flows, like year 2, year 3, year 4, because the cash may only come in like year 5, year 6, right? So the higher you have, and because they are also fueled by debt, right? Then the debt cost goes up, and also when you discount it back, it becomes cheaper and cheaper. But our technology companies over here, the good news, the bad news is it's not really technology. The good news is also it's not really technology. So many of them are manufacturing related. And if you look at the likes of venture, they will continue to grow, and they will continue to grow nicely. And because they have amassed such a huge cash hoard, they will continue to give out very, very good dividends to the tune of 4-5%. And many of the other so-called technology companies, otherwise known as manufacturing companies over here, they do have a very, very enviable balance sheet. And that's the reason why during the tech boom, the Nasdaq boom after 2020, right? 2020 going to 2021, our guys never really enjoyed that boom over there.
I see. So, coming on that tech boom itself, right, and where we are seeing in the market right now, where, I'm just thinking about the risks which we are actually facing. So, what sort of risk should we be actually be looking at? Should I be actually be, as an investor, for example, my mom, she invests, she is investing her retirement money. Where should she be putting her, or where should she be allocating her capital or her money in, right? Should we be setting aside in cash, or should we be allocating, in the different investments? Maybe I'll just open up the floor to you guys to actually answer this.
Okay, they sure arrow me, I know. Okay, the way I would do it is because I think the market started to, after it went down south, right? It picked back up very, very rapidly. My strategy is really, and this is personally what I'll do, is I will start to shore up cash first. You shore up cash and then wait for the next dip. I don't think it's going to go up like this because there's going to be many, many uncertainties. Like I said, with Europe, with US, and this will have an impact in Singapore. So you do that first. And then when you think that it's low enough, many of these very good, you don't even have to go, I know I'm known for small caps, but you don't even have to dig so deep into the small cap space. I am sure there'll be opportunity for some of these big blues. And the first step that you can take will be if your mom is more a retiree type, you want to go more towards the dividend yielding, already the likes of, say, ST Engineering, right? I can recommend stocks. Okay, I'm not really recommending, but then ST Engineering, they really promise you 4 cents per quarter. Confirm one, right? If not, you go and look for government. 4 cents per quarter, 16 cents, you divide by 380, I think that gives you a good 4+% yield, right? That's safe. Singtel, there's many things they're doing right now. I know it's very, very complicated. And many of us, those with white hair, right? They have no hair. Singtel shares, right? We have been like long-term suffering Singtel shareholders since 1993. I think, like many people say, oh, this could be it, but it was never it. But I think that at these levels, it is also a decent shot at the likes of Singtel, because it seems that they are really trying to restructure themselves and do capital management. Bharti is also doing very well, and they're taking advantage of the situation, I think, to sell off some of it and to do those asset allocation on its own. So as I said, all these big blues. I know some people, they like to look at REITs, but of course REITs right now, because interest rates seem to be, like going up a little bit more, I think that there's opportunity for you to come in, not now, but a little bit later. I know some REIT analysts have been saying that, oh, but REIT's very good now, 6% average yield. But you have to look at what's the underlying 6%. Because part of what forms the average yield will be the US-based or the US-based REITs that's listed in Singapore. And those are 10%. If you were to knock that out, I think it's still about 5+%. I think that you can still afford to wait because interest rates haven't exactly stabilized, and REITs depend a lot on the yield spread. Right now, the 10 years, I think, is what, 2.7? Thereabouts, the 10 years is about 2.7. If you're talking about the average REIT right now, it's 5.5. There's still a comfortable spread, but I think the spread can improve a little bit more before you go in.
Yeah. Maybe I'd just like to direct the question back to Teck Kin here. You did mention about oil prices earlier on, and I do recall you talking about some of the emerging European countries facing a shortage of energy in this case. Where do you see oil prices going forth, over the next 1-2 years? And why? And do you think that it can actually hit $200, like what what many other experts says?
Okay, in terms of oil price, I think this we don't expect that to happen, in terms of the $200, because I think we still have some spare capacity from the OPEC countries to produce. And the important thing is a lot of people look at this Russia, right? Now, if you look at the world, it's not that the supply is not there, right? That's important to recognize. The supply is there. Just as it cannot get to the market because of all these restrictions by the US, by Europe, by the European government, all these sanctions and things like that. So that's the reason why prices are held at this level. So if we are not talking about suddenly, the demand is so strong, there's not enough oil to go around, then we have a problem. We are not in that kind of situation. So the crude oil is actually there, but cannot get, or very difficult to get to the market. So it's very hard to predict a $200 sort of oil price. So the crude oil actually can make its way to the market, but in different manners. In different manners, for example, you must pay in ruble from Russia, because you cannot settle in US dollar. The Russian oil companies cannot take dollar. The Russian banks cannot take US dollars, right? So that's where the problem is. So it can get to the market, but in a more roundabout way, and that push up the prices, become more expensive, not as efficient as it used to be. So that's why prices are held at about $100, $120 or whatnot. Sometimes it will come down depending on the news flows. But oil prices may have to stay at this high level for some time, unfortunately, because of all these restrictions. And then the demand, if it continues to recover, let's say if you look this part of the world, I'm sure many of you are planning already, have already done your traveling already since the beginning, since the relaxation, right? Or planning to do so. A lot more traveling, a lot more demand is coming back, right? So that is where the demand is strong, and the supply very hard to get to the market, or more expensive to get to the market. The prices are kept high for this reason.
I suppose just to take a point further, is that again over the past years, we have seen significant underinvestment in the oil and gas industry as well. So if we were to look past, let's say, this current phase where there are risk of recession, etc., and things start to normalize, it's also not easy. So it really is, at that point of what Kim says of the supply side, it may not be easily dug out from the ground because of the years of underinvestment. Partly it is just because prices were low, and B, because of the, I suppose, this sustainable green development where there has been a lot of pushback on new investment into the fossil fuel sector as well. So that's going to take some time, even if the demand comes back to put oil on the market, unless, of course, we see global peace and harmony, friends with Russia, friends with Iran. Doesn't look like it's going to happen anytime soon. And so there's that risk that oil prices, when demand comes back, would not be able to be met by the supply, even if the supplier, the OPEC Plus, were to want to pump as well. So that's another reason why we think going forward, and why PM Lee, I think in last Sunday's speech, talked about inflation may not return to the level that used to be, primarily because many issues have now changed significantly, that disruptions in prices may be more permanent in a different way than before. So we may have to live with that period of higher inflation, higher interest rate. But of course, they're not as high as what we have been used to. We are used to talking, I remember last night, talking with friends, oh, should I refinance, my mortgage? What is it offering now? Oh, 2.75. During the good old days, we're talking about 6-7% mortgage rate. 2.73. It's not expensive. Obviously, it's down when it's compared to like 0.5% is higher. So all these things are all relative to where we come from, whether oil was $10 before or $50 before, and now starting around that $100.
Okay, this underinvestment in the oil and gas industry is actually a very, very serious problem. I've spoken to some offshore marine guys, and what has happened over since 2016, after the oil prices started to crash, right? The banks pulled. They didn't want to offer any kind of financing, so they didn't build new vessels. When you want to dig oil, right, you actually need to get vessels, offshore support vessels, OSVs. There's no new ones out there. So when the prices started to go up, all the likes of Saudi Aramco, they all go and choke and then grab all the offshore marine vessels. Not only that, because of ESG, people are also looking at wind energy. So you have people that look at governments that look at wind energy like Japan. It just within our region, Japan, Korea, Taiwan is a big one, China, Vietnam. And all of them also coup all the offshore support vessels. So they're fighting it out. Right now, I hear that there's very, very few out there. And they're calling rates. Because the rates used to be bottom basement price, now it's shooting up. So therein lies opportunity, because there are a couple of offshore support vessel companies listed in Singapore right now. And I think that may be an opportunity for you to pick up some.
Actually, I'm very curious, Mr. Song. So you came from a private banking background, and I'm just very curious on the ground, what are your clients actually looking at today in this environment?
I also don't know. We have the same discussion over a lot of alcohol. Hopefully by the time they are all totally drunk. I'm just kidding. They forgot the question already. But seriously, I suppose, again, very simply, for many of them, they have basically like us, except this year, the US market had done really well for the last 3 years. So they knew that will come to an end. But we don't know what to do now at this juncture, given all these headwinds, which are still being amplified. We think, and we saw things easing a little bit, but it came back again. So now we are at the same, which is why we are here today, asking the same question as well. So essentially, still stay invested, but how invested are you in, say, US equity? I said it should be a lot less, because you had 3 double-digit year, cannot be repeated. We had been suffering the last 3 years. We should get back, but it's not as easy as straightforward. I think we all like and push for the Asia Bole, China Bole centric, but we are talking about perhaps 5-year time frame. Maybe 5 years we'll get a lot more out from the recovery, and Asia keep playing catch up. But in the meantime, our markets here will still be influenced by what happened on Wall Street. A lot of influence. So it will still be in that sense being just handicapped in that manner. Even news say China may have cut rates. China may be doing more of a selective pump priming, only just kept stocks from slipping further than anything else. So what do we talk about? So it's essentially still about that diversified portfolio. We talk to fund managers at Terrence, just as we do with many other people, and it is really still about trying to look for new ideas, or you can still make money, but it's just a lot more challenging in an environment where you have so many headwinds and rising rates, as well as higher inflation that takes away your nominal gains. So it's very challenging. Is all we can say at this point. There are growth opportunity.
Yep. Following up from Song's topic on ideas, I would just like to turn this topic to take in. We had a chat before this, and you did mention talking about going out of Singapore. Personally, I like to look at dividends, and a lot of my blog readers also, they like to look at dividends for their retirement. is there anything interesting outside of Singapore in the regional markets we should think is actually worth looking at?
Well, this one, regional markets, definitely, I think that is quite interesting. One question is how to access these regional markets, right? So I just want to pick up from what Song mentioned just now, the keyword. The keyword is diversified portfolio, right? So unfortunately, or fortunately, we have to really keep this in mind in our investment. So geographic diversification is one of it. Through direct investment in some of these, let's say ETF that you may have, or to some of the companies listed in Singapore that have exposures in the region. So there are a couple of ways to do it. All right, so I cannot mention names. Unlike Terence, I'm not a fund manager. I cannot mention names. So you can do it this way. The other way is some of these are platforms that actually allow you to invest in geographically diversified ETFs, very low cost, right? So there's a couple of ways to do it, because one thing is that if you look at the region, Southeast Asia, there's a lot of growth potential. There's a lot of upside. There's a lot of growth potential. And I have some, actually many years ago, 20 years ago, 20, 30 years ago, in the Asian financial crisis, I bought some Thai fund. I have kept it from at that time until now. So the money, I don't know, I don't even keep track of it, but compound quite a bit, double, triple, that sort of thing. And many years ago also, 10, 20 years ago, I also bought into China fund, Indian funds. So again, I just left it there. I told Willie, it's like collecting stamps like that, you know, when I buy stuff. I just buy it and then keep it one side. So the money just multiply by itself and collect the dividends on the way. So to wrap up, so there's diversification benefits to look at all these different regions, aside from Singapore. And Song mentioned about the US equities, when to come in, etc. But I want to add one point. The final point is that somebody say time in market is better than timing the market, right? So it's important, right? Time in the market is better than timing the market. So for some of us here, white hair already, but you have young children, and that's what I think all these children or the youngsters here in the crowd should do, is to stay time in the market, because inflation is going to erode your cash savings, right? Inflation is going to erode your purchasing power. So it's better to stay invested.
I see. So coming to the topic on diversification, right, Terence? As a fund manager, how should investors diversify, and what sort of diversification strategies do you actually recommend for investors, especially for investors who want to start out investing?
Well, because I look a lot at equities, right? But I do have other funds. I've got one of those private debt fund which gives out above 6%. So what I would tell my investors, they are largely those accredited investors. They should put some into one of these safe funds that is totally uncorrelated with the market. It gives you good, and we've been getting consistent use of over 6%. That nothing to do with stocks. And then we have another pool. I don't have a bond fund, but that one is as safe as a bond fund. Then I do have the equity portion. And the equity portion, I try to diversify across. I used to be a little bit more adventurous. We used to have a bit more kind of like exposure to the small caps. But now I diversify across. Maybe small caps, you have 30%, and 70% will be the more liquid blue chips. And it depends on when we buy it. Because some of these blue chips may be the growth companies. Some of them are, more dividend generating, more value ones. And if I see that the market is weakening, I may take a step at the value stocks. But when it comes to a time where people just want to throw in the towel, they call it the capitulation stage. Perhaps it's time to really go all out, and you just whack on some of these good growth names that have been around for almost forever. And they are, like say, big blues. People, come on top of your head. If it's property, you think of the likes of CapitaLand, city developments. If you talk about offshore marine, will be the likes of Keppel. Then the banks, all three banks you can grab, right? So all these guys, we haven't hit that stage yet. The last month, in fact, the market started to pick up, like I said. So hit a capitulation like maybe 2-3 months ago when the market was like really in fear. I think that's where you can go in. They say, hey, but we come in right now, what if we lose money? I can assure you that 95% of the time in the 1 month from then, you will lose money, right? But then, like what Tekin say, you just wait. You wait it out, and then past the crisis, you will enjoy it. You see, when you come at this point, you may lose 10% of your money, but if you wait like another 2-3 years when everything bounces back up, you will have gained, you have doubled up, right? So I think the risk reward is there.
How about talking about regional, right? Earlier on with what Tekin mentioned. So we are looking at, years ago we are looking at the Asian growth story. Is it still intact today? I mean, when we are looking at ASEAN's GDP on average is about 5% growth quarter on quarter in the previous quarter. And especially if countries like Thailand, the Philippines, and even Malaysia, where you are still recording pretty good single-digit growth rate. Is that where investors can actually continue to look at?
Okay, just in terms of, let's say, Asia, okay, is there still an Asia story or growth story, etc.? I think I'm quite confident about our regional, in Asia, particularly the regional growth story. I think it's still there. One thing is that these are regional countries, the population is quite large, right? 600 million, 700 million people. And that, a lot of it is in Indonesia, 300 over million. And more than half of them are very young, you can classify a young population. So when you're a young population, you don't have to worry. As long as the income is growing, there's potential for these countries, right? So very important. And the reason why Japan has suffered for so long, over the past 10, 20 years, because the population has actually, not just aging population is actually shrinking. The population, once the population starts shrinking, then you have a problem, right? Just like the PM Lee over the weekend on Sunday talk about in the National Day rally. What did he say about Paya Lebar area? Singapore no need to worry about not enough houses, It's the people to fill in the houses, right? So have more children, and also the population need to grow, whichever way, whether it's organic or by acquisition. Right? new immigrants coming in. So for this part of the world, Vietnam 100 million people, Malaysia 40-50 million people, Indonesia 300 million people, Philippines 100 million people. All these population, a very young population. So that will be a lot of room for us. And if you look at the recent news, that's a final thing, the recent news about the EV, right? Some talk about sustainability and Terrence as well. The EV companies, the manufacturers, electric vehicle companies, are going in droves into Indonesia, right? The Japanese companies, the Chinese companies are going in droves into Indonesia. Why? They're seeing it as a huge market for them, and also a production base for them. So a lot of companies come in to this part of the world, to invest in this part of the world, not just for production, but also for the market. So a lot of space, a lot of room potential, really.
I think just to add on one point before Terence is in terms of not just the young population, but the technological shift and opportunity created by what we're seeing today that allows for small entrepreneur to be able to provide services that in the past could not have been able to unless you are a big conglomerate, is really accelerating the creation of small families who are then growing faster in wealth accumulation, and this amplifying across, whether it's in Indonesia, Malaysia, Thailand, Vietnam. So it adds on to the Asian growth story in that rather than the traditional route of employment, working with multinationals, etc., there are new growth opportunities now, income growth coming from riding on technology which didn't exist before. So I think that's also another difference. Okay.
Thanks, tech team. I think very, very important is geopolitics. Because back in the early 90s, Southeast Asia was a manufacturing hub. You go Malaysia, Indonesia, Thailand, everybody was bustling, Then the great sucking sound up north started to suck up all the FDIs. That's China. China developed a very, very entrenched, city like the whole area was like all manufacturing, and people like to situate or put themselves in all the it became a big manufacturing hub. But some with all these geopolitics, US fighting with China, Europe fighting with China, Japan against China, many of these investments are coming back to Southeast Asia. And like you said, we have a young population. I cannot say very, very industrious, but getting there. And we have the infrastructure, the know-how. Back in the early 90s, late 80s, we were there. We know how to set up factories, right? We as in Southeast Asia, right? So geopolitics is helping Southeast Asia. And actually, it's not only when Donald Trump came on board. As early as 2011, 2012, some of the manufacturing companies have told us that their customers in the US, in Europe, are asking them to diversify out of China already. They were too worried about concentration risk within China.
I think on that note, before I close up this panel and also open up the floor to Q&A later, maybe I'd just like to just go around the table to talk about what are opportunities, the sectors or the countries which you are looking at and what you're actually looking at right now. Maybe I'll just quickly go across the floor. Maybe I start with Song.
Well, I suppose the key thing which I'm still currently looking at still really is inflation expectation, whether prices has peaked, whether the basket of goods and services that you and I sort of consume have prices peak. We clearly see prices for some item has peaked, in terms of, let's say, palm oil prices. We have seen it double up. We have seen it come off, but it hasn't come up in a significant way to what it has risen from. It is still bouncing around. So if you look at, say, key commodity indices, whether it's the Bloomberg one, whether it is the UNFAO one, or London metal prices, things have peaked in June, but it's not coming off in a big way. But at the same time, while we say, hey, why prices haven't dropped? It is because not everybody raised prices at the same time. If you go down to the youtiao shop, their cooking oil double up from $25 per kg for that, I think it's a 15 kg tin, to something like $50, 50. So it's double up. But your youtiao haven't doubled in prices. It may have shrunk a little bit. So along the way, different businesses had absorbed costs at different levels, and with prices now stabilizing, coming off, they are finally putting some of the higher prices to you as consumer. So all these things are still taking place, which is why we think headline inflation may have peaked, let's say the US one, because oil prices peaked back at, say, on average, US $5.50 per gallon. They're still stuck in the second world, in the ancient time, where it's still metric gallon and pints and semikui, whereas the rest of the world have gone metric already. So $5.50 per gallon in the US. Now it has risen from something like $3.50 at the beginning of the year. Now it's somewhere around $4.50, so it's down $1. But because fuel cost has gone up from the beginning of the year, you will see businesses adjusting their prices along the way as well, whether they are canning companies or whether they are beer companies. So what I'm looking at really is still the secondary effect of all these prices that's still being passed through to see whether it has accumulated together over time, impact consumption in general, or we still say, okay, it still costs more, but I still complain and pay and consume. If that is still the case, then recession risk is low. It's only when we complain and say, wow, I really complain and I really not consuming this basket of goods and services, everybody start pulling back from first row down to second row. If that happens, then it is recession. So what am I looking at is really signs for that, of pullback in consumption. While we complain, we're still spending. Okay, complain and spend is okay. Complain and don't spend, okay, that is bad.
Yeah, I think that's a very interesting point, Song, because you mentioned about actually inflation is kind of a good thing because as long as people are spending, it sort of grows the economy. But what we want is, of course, a balanced out effect where you don't really want to have an overheated economy. So while a lot of people tend to be afraid of, inflation is coming up, but if we look at it closer, right, inflation is actually good for the economy.
It's only good if the labor market is still supportive of consumption. Like the US now, next week? Yeah, next week, jobs report. We'll probably still see a fairly healthy number, maybe even as strong as the previous month. If so, double joke confirmed it will be 75 basis point high one for the central bank until that starts to come down. So very important. Why are we still complaining and still able to spend? Because we all got jobs. We still got a desk to return to or a virtual desk to go back to. The moment businesses start to pull back spending, investment, hiring, and then that will be what the worry will come in. Are we there yet? Not yet. So this is part of the thing. The labor market condition must be supportive of the consumption, and this is where I think the Fed continue to have confidence in that. Hey, your claims has gone up, but it's still relatively low. People are still hiring than firing most of the time, although some of the tech companies having to finally say, you need to make money, man, start to be more careful about cash flow. Also, so there are signs of slowdown, but not enough to take the wind out from the market just yet.
How about Tekin? What sort of opportunities are you seeing in the market now?
Right. That's a very important question and very hard to answer question, right? Because Song already mentioned, wow, you have to watch out for recession and also inflation eating away your purchasing power and all those things. So I always say that for me, just now I mentioned time in market is very important rather than timing the market. So time in market is very important. But sometimes I'm very lousy at predicting. Sorry, I think very hazardous. I'll talk about this. Lousy in predicting, right? So I try to, personally, I told Willie before, I'm a lazy investor. Right? Since we're in InvestFair today, talk about investment. Personally, I'm a very lazy investor. And you go to Willie's website, there's actually a book called Lazy Investor Guide. Right? So I'm a very lazy investor. So what are the opportunities? For me is that I just close my eyes and invest monthly. Right? I just put my money buying whether the market up or down. I just put some part of the money into the market and buying. So when a high, fewer units are. When it's low, so more units, but still investing. And my wife does the same thing. She's not working, but she does the same thing as well. So we buy on a monthly basis and accumulate our portfolio. Of course, it has to be, that means all these opportunities are very hard to predict, right? So I might as well just continuing to buy. Now, of course, it depends on your risk appetite and all that. So you have to calibrate carefully. And fortunately, today, we have a lot of platforms compared to 10, 20 years ago. Today, we have a lot of platforms that we can do all this. You want to go tailor-made, you can go to Terrence, right? Or if you are AI, you go to Terrence. Terrence will help to manage for you. For the average guys, a lot of platforms like me, I just use one of these platforms. For example, UOB, we have this monthly investment thing that you can do that on the phone app, or you can go outside. There are many other places to do that. Very important to stay in the market to capture the opportunities over a long period of time. Right? Short term, we are going to have up and down. But over the long period of time, companies that can adjust their prices to this inflation, they will win out, right? They will manage to maintain their profitability. So we don't know which one. So we just on all these ETF and things like that is another way to invest your money, right? Really?
Thank you, Tekin. How about Terrence? I would love to hear your thoughts.
Okay, I've got a couple of themes for the Singapore market. Singapore, remember, 2 days later, all unmasked already, right? So it's going to be a reopening theme that I'm looking at. I know this has been played out many, many times, but I think that there's still some room to grow. The likes of, taxi company like ComfortDelGro, there will be more tourists coming in, so there'll be more use of taxis and MRTs, right? And be mindful that over the years, many of these taxi guys have thrown in the towel and given up their taxi licenses. I think taxi population have gone down to about 14,000, right? And that's quite a drastic fall from what it was pre-COVID time. So I think there's room for growth on that front. And given that this is a company with 600 million, I'm sure you can find it on Dividend Titan, since it is a good dividend stock, right? At 4%, this decent dividend is safe and it rides on this reopening play. There's also the malls that you can look at, the mall REITs, but I personally think, like I said, REIT, you can wait a little bit longer. But then if you are impatient, you think that, hey, you're quite happy with this 5.5% yield that the average mall REIT is giving you, then okay lah, right? You can, like I said, timing the market is, no, time in market is better than timing the market, okay? Yeah. Then some people go, hey, wow, if it's going to be reopening play, easy lah. Hospitality REIT, right? But hospitality REIT, if you compare against the rest of the REIT, why is ranked, I think, lower? Because why you buy into REITs? REITs, you buy in for dividends, right? And And even though we're going to see big growth, it's going to see the biggest growth in terms of earnings, in terms of the dividend payout growth, right? But then the yields itself is still low. I think for this year, it's still like yielding circa 4+%. Next year, then you creep back up to 5%. Whereas the rest of the REIT universe is already at 5%, right? So that one can wait. But property companies, I think, are kind of interesting. I know many people have been talking about property companies almost forever, right? But property companies, they are trading at big discount to their RNAV, and some people will see it as an inflation hedge. Though, of course, I will caution that if the big wave come, like say, go and tekan the market, the property guys being a bellwether would be hit also. But then you are backed by the NAV of the company. So property guys look interesting. And if should the market take a tumble, I think that there will be opportunities within the privatization front. Privatization has sort of like slowed down a little. Though recently, Tuan Sing made an offer for SP at 160% higher than the last traded price, right? There will be opportunities where you just need to look at if it's trading like a big discount to RNAV or a big discount to its cash. There are some companies that have net cash and they're trading at cash level, which means that you get the business for free. Many of these are candidates for privatization, so you can look out for that pool also should the market come off.
All right. Thank you so much, Terence, Tekin, and Mr. Song. So maybe we just open up the floor to questions. We have still some time here. Maybe we'll pick 2 or 3 questions. Yes, can we get a mic for the gentleman in front?
I think all of you are very too optimistic. Haven't we learned from the Asian financial crisis? Haven't we learned from the crash in the Nasdaq crash about 2001? And then haven't we learned from the aftermath of the Yom Kippur War, 73, 74? Inflation was sky high, and the Arabs will not pump the oil from the ground. It was called brownout. So, would that come again? You see, the Thai baht, the spark of the Asian financial, it wasn't the Thai baht, and they went to Korea. So, have you thought about that scenario? All the saying is, oh, the future is good, the future is good. You all look like a good Tuisitala storytellers, like Robert Louis Stevenson. Can you think of a bad scenario? The two sides of a coin,
Uncle, just now I say the market sure come down one, I think you're sleeping, right? I should have thought in direction wake you up. Right, but I am particularly negative on the market. And I've been negative on the market for quite a while right now, right? And I believe there will be a big shock because you cannot possibly have so much money come in, so much excesses, and the pullback cannot be gentle. No way. You're right. No way. Right? So the market come up, I already said just now, dead cat bounce.
Okay, I would like to hear the views from one of our economists here. Maybe I think I would love to hear some thoughts. Taking a song.
Okay, maybe a quick one. They always say the market climbs a wall of worries, right? Yeah, the market always climbs a wall of worries. Okay, all these are negative. All these bad scenarios are out there. So we have plenty of scenarios. Actually, if you ask the people, risk management people in the banks, they always do all these worst case scenarios. They always run all these worst case scenarios. So are we going to repeat what happened in 97, 98 in this part of the world? Unlikely to repeat. If you look at some of these numbers, they don't support that kind of scenario, situation. For example, Thai baht. So you mentioned Thai baht. Now, if you look at Thailand, the reserves are about 40% of GDP, In the past, they did not have enough reserve. 40%. The lowest in Asia, the lowest in this part of the world is 10%. 10% of GDP, the reserves. Singapore is about 75%, very high. Used to be 100%. Now 75% because some of the money is actually being managed by GIC. So it actually dropped from 100% to 75%. But the point is, there are enough reserves to support the market. What will hit us? All these are black swan things that we never thought about. For example, COVID. Who would have thought that COVID could happen and then hit the market so bad? Right, 2 years ago, 2020, in March and April. it was like the end of the world, Armageddon. Terrence used the word Armageddon. Should have bought at the time, right? All the stocks. Should have bought at that time. But anyway, so something when something hit us, it's likely to be that something that we didn't see before. Okay, so the important thing is to stay diversified, right? And also not to leverage yourself, to over leverage yourself. That's all I can say.
I think it's very important to worry, because I always worry whether tomorrow morning I can wake up or not, That I wake up is good already. Now, very importantly, I think you raised good question. Coming to say Thailand, we learned from the Asian financial crisis. That time, currencies, Thai baht, ringgit, we were pegged. We had fundamental imbalances. We learned from the Asian financial crisis and subsequent crises, which is why we think the risk of such event happening is low, which is why every year, in fact every quarter, we do risk stress tests, we do a capital adequacy. Central bank says you cannot over borrow. So we look on credit card balance, we look at housing leverage. So we are constantly looking out for such things. So in the event of an external shock, we know we can at least come up far faster, because you will and most likely get less job losses than one we had experienced during the Asian financial crisis. But that again doesn't mean that we have no crisis. One of the biggest ones that I continue to worry about now, let's talk about the Europe side, is obviously geopolitics. When the US constantly try to poke China to starting a war over Taiwan, for instance, even though we know the politics of China-Taiwan, you don't cross the line of independent. You do so, that's it, that's a red line cross. But we don't know if that will happen. That is certainly one of the black swan events that if it happens, will have significant repercussion around. So there are certainly risks. But in terms of the current risks, I think they are manageable. We can deal with them, more or less. But there are going to be short term, as I say, when you really throw money from the sky, and so much is when cost of risk is zero, and now cost of risk is climbing, although it's no longer zero, it's like say 3%, but it's still climbing, it is still risk, which is why tech companies who didn't make money now have to start worrying about no more free lunch, because it still costs something. So all these things will have implication, but yet at the same time, we still see job creation, because technology which exists today create opportunities for new income growth. So which is why I say there's still opportunities longer run. Short term, yes, a lot of stress that are coming through from within this region, from outside this region, and even weather and climate change is a significant risk as well. We continue to have more water, so we don't complain about drought, but obviously elsewhere in China, in Europe, in US. So all these things could be a handicap and pull back on the economic activities on top of higher cost of borrowing as well. So lots of things to worry about, but manage the worry, otherwise you'll never go to sleep one.
Thank you, Song. Okay, any questions? Maybe you can have the gentleman over there in green.
Hello. So I've been reading a lot about this news that the Fed is going to proceed with quantitative tightening. And beyond all our conversation that we are having here, this quantitative tightening is something that the markets have not really priced in. So that means the Fed is going to reduce their balance sheet. The money supply is it was a lot when we see one of the previous charts. Then the money supply is going to reduce. So I also want to hear your views on this. And also I know we all Singaporeans, we like to travel to Japan, but I know you all say something about Japan, but in 1985 to 1989 to 1990, that period, why so 这么凄凉? Why? Because you can go and Google, there's this thing called Plaza Accord. The Angmo, because Japan was the second largest economy of the world, they scared already. They scared, then they go and disturb Toshiba. Then they make them jialat until all the assets, then until the 各国家没有动力. So sometimes in life, we got enough life experience. Sometimes the moment we have anything, if I say ASEAN got a currency that is going to threaten US dollar, they will play with you. You see, so this is life experience, but I think more important, let's look at the impact of quantitative tightening. Yeah.
Okay, so quantitative tightening. Everyone like to take
Okay.
this question?
Maybe a quick one on quantitative tightening. Actually started already. So the quantitative tightening is to reduce what the Fed had pumped in, right, during the financial crisis, during the COVID situation when they cut the interest rate and also increase the money supply. Yeah, dropping money from the sky, Song. Right? Yeah, it's really dropping money from the sky, and the part of the inflation problem, the supply chain, and all that problem that we have today is because of all this loose policy. But anyway, the quantitative tightening has been going on. Has been going on. It started already, and the equivalence, from what I read, the equivalence of this quantitative tightening, the QT, is about 25 basis to 50 basis point increase to the interest rate. So it's not going to be like 2, 3, 4, 5%. It's going to be 25, 50 basis point adding to the interest rate hike. So it's not going to be significant. So that is the reason why I think the market is more reacting to the interest rate hike rather than to the quantitative tightening. Yeah, you could. Yeah, you could.
It's not an unknown factor. It's already known that there will be shrinking the Fed's balance sheet. So it is more the accelerated increase in cost of borrowing that caused the jitter at the moment. But you're right, as Terence pointed out, all this free money cannot just be let loose out there. It will have consequences, and this is where trying to take back is essentially say we lay up, everybody have a bottle of beer now. I take it all back, and you have to pay more now for that beer. That caused people to be stressed out. So these are the worries that is still happening. But again, it's all relative. Europe, quantitative is also trying to roll back and raising rates, but even after they raised rate last time, it's still zero. So it's still very low at this moment. So even if they raise 50 basis points, the next time it's still 0.5% as well. So it's still relatively low from there coming from. But I think it's more of a shock of how quickly and how fast it goes that threaten to trigger a recession. So for now is why I'm still watching is all this talk of recession and rate hikes and higher cost of borrowing impacting everybody's daily life in a significant manner. So far it hasn't, which is why it's good. The moment it starts to be more significantly affecting daily life, then we know it will be a lot more troublesome. So this is where I think the central bank's challenge is how much on the QE side to manage, how much on the interest rate side to manage, how much government in terms of fiscal policy will adjust. So it's playing out. So US politician caught in a bit of a bind, which is why Biden even have to say, adding on to the QE is they forgive the student loans, the 10K. So people are calculating, that can add something like 0.2 points to the CPI. I say, okay, so these things are still playing out. One side is pulling, the other side is giving, because politician, they need to win and retain their job at the same time too. Don't know whether Terence have more to add on to that.
No, I think you're just showing off quantitative tightening, right? Just now I say take back money, you want to say... No, but we have been using the same... we have been talking about that, all the excesses and then the money coming back. That would lead to a natural decline because, like I think Uncle Song was saying, when your money is free in the past, you buy whatever thing also can make money, right? As long as yielding, so that's why everything went up. So now, as they are trying to pull back, this will result in many different asset classes coming down together at once. And on the topic of Japan, it's interesting because I thought back in between 85 and 90, I know Plaza Accord, it was really, really heated up, especially the property market. Do you know that Tokyo Palace was worth more than the whole state of California at one point in time? That's ridiculous, right? So I think they had their day of reckoning and they just never woke up from it. And one of them is demographics, I think.
Okay, I think with that, we have come to the end of our panel. Let's give a warm applause to all our speakers, to our three speakers here. Thank you so much. And